In this video, traders, we're going to look at the floor trader's strategy. Stay tuned. Hey traders, a very warm welcome to you. So this is one allegedly used by floor traders. I don't know exactly the time frame these guys would have used it on. You know, when you speak to people in the pit who have traded in the pit, especially the CME, they always would not necessarily use charts as such, right? They'd have the chart in their mind before they came into the day, but then once they're in the pit, they're trading off pure supply and demand and order flow. However, this has probably come around from the transition from the guys who are trading on the floor to trading in upstairs, or in other words, trading electronically and electronic local. So let's have a look at the rules and let's see if there's something that we can perhaps take on board to integrate with our own strategies and setups. So I've got here two moving averages. The simple moving averages in the settings are 18. It's my red moving average, if my mouse doesn't go crazy here. And I have a 9 period moving average, which is the blue. So a 9 and an 18, they're both simple. The time frame I've chosen for this is a 5 minute. Now I think this is probably the sweet spot for this setup. If you go any higher, and I know that a lot of pit traders were using kind of hour plus, even if they were using a chart, because it segmented the day nicely for them into bars. But I think they would not have used this strategy, because you'll see the rules in a second, but by the time you get into it, you're probably a little bit late. So let's stick with a 5 minute. But anyway, once you've watched the video, guys, let me know your ideas and thoughts for time frame usage in the comments below. Like I said, I've only got a few details about this setup, but I wanted to do a video on it because it's the sort of thing that you might be able to take a few ideas from. Okay, so intraday time frame, obviously floor traders, we're looking at intraday markets. I've picked out two of the ones which obviously we have had floor traders on. So S&P 500, I'm using the Spiders ETF just purely for simplicity purposes, but obviously the S&P 500 is the equivalent of what the underlying, and there was a big pit presence for that. And USO, which is the crude oil ETF. Now, can you use it on other stuff? I've not looked at it, but again, if you guys want to check it out with some of the major currency pairs, I'd be interested to see your findings. Okay, so the settings, we've talked about settings. We've just got a naked chart. Other than that, the idea is you're looking for a buy entry when the 9 period slopes up, the 18 period slopes up, and you get 3 consecutive bars or candles that are fully above both of those moving averages. When you get that, you take a subsequent long on the break of the last high, or as well as you wait for a pullback to the 9 period, and or depending on how you're trading it, you wait for a pullback to the 18 period. Okay, so you've got some options, which is why I think this is worth investigating a little bit more. Spiders example here, we have across, we have the slope up on the fast and the slow. We have at least 3 candles trading above both moving averages. Then we get a break here, so our buy candle is here. We are long here. We are adding to the long here as well, if we're trading that way, or we're waiting for that. Depends on how you want to do it. You want to be super aggressive, you take a breakout of the bar on the high. Obviously you can see why that's aggressive. Your risk is going to be higher, but you're trading that momentum. Or if you're less aggressive, you wait for the pullback to the fast moving averages. Fast moving average, if you're kind of really want to trade it passively, you wait for a pullback to the 18 period. Now you're going to see why I perhaps don't think that's as good. I think really, even though the rules are those 3 rules, I think really we should take the break and only the pullback to the 9. I think the 18, by the time it's pulling back to the 18, you've got another filter in it. Let's talk about that in a second. So you'd be long on this candle here as a break above the high. So the high here was on this S&P 5, oh sorry, Spiders ETF is 279.91. So you'd be long at 92. Your stop would, I guess, be below the low of that candle, would make a lot more of sense. So you've already got a 5 minute candle range, makes sense intraday basis, and your target is going to be kind of 3R, something like that, so you get a decent risk reward ratio. Or most of the pit traders would hold it until we broke a previous day's high, or they'd hold it until the close. That's generally how these guys used to operate. Same for buying a pullback. We're buying a pullback to the 9 period moving average here. You're buying it literally as it touches that moving average, and again, you want to hold it for new highs, you want to hold it for multiple times your risk, you want to scale out into that supply demand imbalance, or you want to go and hold it until the close. And if you're feeling like it may be a longer term setup, you hold it for a follow through to the next day. So that's S&P 500. Let's look at crude oil. And I appreciate I've cherry picked this one a little bit. I've scanned through and found something that's good. But I think this is the idea of the trade. The idea of the trade is you're going to have to accept a few little stop outs, a few little scalps, grabbing a little bit of a few ticks here and there, sticking a bit of money in the bank, losing a bit of money, just kind of breaking even, a little slightly profitable. But the point is, this is geared up to jump on when you really get the momentum. This is a great example for crude oil, right? You've got 1, 2, 3 candles that trade below as a sloping down 9, a sloping down 18, is sloping down 9, 3 candles trading fully below. You trade the break of the lowest candle, which would be here, which gets you in at it's 1480, whatever it is on the actual crude oil futures. Push lower, you then add to the position as you pull back to the 9, which is here. You add to the position as we pull back to the 18, which is here. Great, you've got a nice aggressive position now. It starts rolling, and then you're away. Now, even if you hadn't taken it on this section of the trade here, you can see how it works well with momentum on the subsequent sections. You wait for the 3 candles to trade below. Definitely the moving averages are sloping down, and the 9's under the 18 for the short position. You're taking short and you're trading this sucker as long as you think it's going to run. And even if you held it until the close, you can stomach that pullback because you've got so much meat in the trade. So whilst accepting the criticism that this is possibly cherry picked, I think this is what the point of this setup is. It's to break even and kind of scalp a little bit out of it. And I wouldn't be kind of defend not scalping it. If you get this scenario during the day and you get 3 bars, you take the 4th bar and you kind of take a couple of bars worth of move, 10-15 minutes worth of scalp, take some off, maybe leave one for a runner for the potential big move, I'd say that's fine. But if you really get a good move after you've taken the trade like you do in this, it's the one to hold back on and then be pressing the trade, because that's where the big juice comes in, guys. I talked about this before. If you're subscribed to the channel, appreciate your support, and you've seen some of the videos where I say, when you're right, press it. Be prepared to give back when things are lining up for you, and this will be one of them. It comes in your direction, you take the short, adding to the short on the pullback, you're now in a decent sized clip, you've got a decent cushion, and it goes your direction when you're in a full boat, which is what you want. You're in here, you're in here, you're in here, you've got cushion, you've got position, your average is probably going to be here. The thing then rolls when you're in a decent size, you run it for as long as you can, and if you held it to the close, you're going to make kind of significant money that's going to make up your month, your quarter, whatever it may be. So interesting one this. There are some things I think we need to adjust, and like I say, I think this is the kind of thing we adjust and say, hey, when it starts going your direction, look to add on those 3 points and press when we've really got a trend in your direction. And using those 3 bars rule gets you in early. It might get you flicked and whipped out a little bit and kind of break even a lot of trades, but what it does do is it gives you a good possible time to then bring your average entry up a little bit when you're getting extra aggressive on those shallow pullbacks when the moving average catches up to price. So that's a floor trader strategy, guys. Let me know your thoughts in that comment section below. Whatever you're doing, keep the risk managed. To the next one, take care, bye bye.